Hello, everyone, and thank you for watching my channel. My name is Reggie. I am an entrepreneur and a stock trader, swing trader. I guess I'm considered categorized as of right now, because I do what the market tells me. So whatever the direction the market goes, hey, I don't fight the current, you know. So swing trading works for my financial goals, my budget, my time that I have available to trade. So swing trading works for me. Anyway, this video is about debit spreads. Debit spreads at this current moment is my primary way of trading the market. I mean, I do have long positions. I mean, my portfolio is made up of anchor stocks. And anchor stock is, your primary stocks that you just buy and hold, and it keeps your account at the level it's at. Like, especially if, you do a bad trade, like you don't want to, especially with options, you don't want your options to be the bulk of your portfolio, because if you move in the wrong direction, you lose all your money. With equities, or, actual stocks, if the market goes down, you just hold and then you just wait. Naturally in the United States, our market naturally goes to the upside. And trends as a bull market. So that's an important part of your strategy, having your base playbook, and then you have a small percentage of things that are riskier, such as single option trades, which I rarely do. I usually do debit spread or credit spread. So just to show you how I perform that, let me go over that with you now. And I'm going to use Apple as an example. Again, if you have any questions, feel free to message me. Also, none of us is better than all of us. So there's a wide variety of other videos available to us thanks to the information age we're in the internet. But proceed with a very good filter. You don't want to, some people have agendas where they want to sell their product and stuff, which nothing's wrong with that. But some people use, I would say, uh, not good tactics. I'll leave it at that. So just and also, what I say in every video, don't blindly follow myself or anyone else trades. You take the information, you uh, filter it, and you try to take out what you can that fits your personality, that fits your trading style, and also your goals. So, again, none of us is better than all of us. So we all take a little bit from each other and kind of cater it to how we can maximize it with our personality, who we are, the time you have, and the money you have to spend. So with that said, let's get into debit spreads. So we got Apple, right? So first things first. With Apple, right now it's showing a flag pattern. So you want to get into the technical analysis first, because you want to establish your. Actually, let's do it. Your entry point and your exit point, right? And your risk, your overall risk. So I'm gonna draw a trend line here. People that do technical analysis, we all have our own system of trend lines, but we're all in basically the same ballpark. And you kind of want to have as many touches as possible. Sometimes I like to be a little bit outside of. I don't like to have too many candlesticks poking outside of my trend lines. So this one probably move up a little bit. Okay, so for me, this is the channel that Apple is trading in, and it bust through here, failed, consolidated, hit this support line here, jumped, bam, hit his head again, fell hard after hitting his head on the wall, the ceiling, up, consolidated in the middle, came down and jumped again. It's now I'm expecting, the pattern would show maybe it'll come down to this 119 mark, which it seems like it's been fluctuating at. And then this is a daily chart too. Come down here, possibly come down here. We hope and find support. Maybe right here in the middle line of the Bollinger Band here, and then come back up. At some point, Apple will pop once it hits with some volume. Right now, it's looking kind of weak because of the volume, but I've got other videos about Apple right now. The whole point is to show you a debit spread. And with the way it's consolidating, it may not be the best on this one, but let's hypothetically say for some reason you decide you want to do a debit spread on this, right? And so you're thinking like, okay, it's gonna if it busts through the support, the next level is where? Then the last high it had was at 137. So it could hit 137 and come back down and maybe have support of 126, right? So with this scenario, you want to try to place a debit spread between 126 and if you're very bullish, 137, 126 and 137, right? So let's look and see how that looks. So we go here. This is Etrade. Well, every platform has this. So if you want to be very bullish, you may need. I mean, see, this is where your own strategy kicks in at, right? I probably wouldn't take this trade, but if I was bullish, I mean, I wouldn't take it for the simple fact I won't hold my. I don't like my money being held up this long. I like quick trades in and out. But if you're a little longer, you can go from. You can try to play that range, the next range, which would be 126, and I would probably not go past 129. So hypothetically, right? This could be a bad trade for some of us, and the point is, I'm showing how it works. So we have a $3 difference between a strike price, right? So a debit spread is when you buy one and you sell one, right? And so how do you know how to be profitable, right? So I automatically calculate this in my head because I've done it so long, but let me start back. And so what you want to do is if you trade options, this website needs to be your right hand man. Optionsprofitcalculator.com. I have no affiliation with them. They don't pay me. I'm open to get paid from them. But they're this works, man. It's nice. Now, the accuracy will get you in the ballpark, right? Because one thing I don't like about it is I don't know if it's been fixed yet or not. The theta, and theta is what your chart, like if you have an option, you're holding it, it loses value, right? Time value. And so when a market is closed, it's not theta is not calculated according to my research. And so this actually charges you theta over like weekends and holidays and all that stuff. And so it may not necessarily be accurate if you're trying to do like look at Monday, and you actually probably can make a little bit more money than it's showing because it's hitting you with theta burn. So anyway, we're gonna do a call spread, and sometimes too, even on mobile, this site doesn't refresh well. You try to like if you try to change up here is where you have your strategy that you're trying to implement, and it'll help you walk you through it. But if you change it, sometimes you got to refresh the browser and all that. It's a little weird. It's got its quirks, but you'll learn it. So let's put Apple here. And let's see, 26 and 29 on the 24th. So you want to go to your what you're buying. So go up here to the date. Don't forget to put the right date in there. That'll throw you off. And I would not make until you get this down packed, I would not make a physical trade using this. Because you can make a catastrophic mistake if you don't change the date or something. And you think you're making a certain amount and you're not. So I got sidetracked. Put the wrong number in there. Delete. All right, so we got 26 and 29. So let's say you buy this 26. You buy this 26 call, and boom, you sell the 129 call strike, and this will calculate it for you. Hit calculate. Boom. So what you do is now it's going to cost you your debit spread. Nice thing about debit spreads, the max amount that you will lose is the money you paid up front. So this will be $72, right? So sorry, maximum risk $72. If the option goes and expires at 126, your maximum profit is $228. Again, uh, use it as a range and not, as the Bible, right? Um, and this is a nice graph. I love this graph. It shows you your profitability and it helps you with theta, right? So I'm gonna do another video on theta because with this setup, a debit spread, your theta burn is a lot less. Make sure my dates are right. Yeah, your theta burn is a lot less. So it's calculating here. So let's say on December 11th, this Apple's at $131. See, it breaks down to you, okay, how you making your money. Even so, your net profit is $125 on this debit spread. Your net. So you spent 72 to make 125 net in your pocket. If you take it all the way out to expiration and you let it expire, and both what you're selling and what you're buying are in the money, so you basically that's a real easy calculation. You basically get the difference between what you bought and what you sold. So 126. So you take 129 minus from 126. That's $3, right? So you times that by 100 because it's 100 shares. So that's $300. So if these both expire in their money, you make $300 minus your 72 minus any fees that your broker would charge you. Sometimes they'll charge you a um, fee for expiring in the money because basically you're buying 100 shares and selling them simultaneously at the same time. And so it's called an assignment fee. So it's an assignment fee with that. So play around with this, guys. So use option profit calculator to figure out how these things work. And especially if you're buying single options, right? And actually, I'm going to show you a quick example. Hopefully this thing will let me. And you can also change the dates too. So let's say Apple somehow blows out to 140. Then you can stretch your timeout too. Bam, you can see complete profitability if you think it's going to blow out, and you can see your losses. And the debit spread, see, that's what I like about debit spreads. But it depends on the Greeks on the options that you're selling, right? So if you have like some debit spreads, you can actually lose the price will go down a bit and you still be profitable. So it depends on how the Greeks are set up. But that's what I like about debit spreads. See, it allows a lot longer time for you to be right before you start losing money. If you go in here, because what'll happen if you do let's do a single one real quick. I try to make these videos short, man, but I get into it and hang on. And so a credit spread is very similar. I'm gonna do a credit spread too. If we're gonna credit spread, let me show you this quick example. 24th. 20, we're at 29, 26, 26. All right, so you see the difference? If you just bought this, you just bought the option by itself. Oh, the date is not. Hang on. Yeah. No, it says 24th. I don't know why it says. It's actually glitchy. See, because it says fourth here. I don't know. So anyway, as you can see, this one, the theta decay is a lot faster. You're risking a lot more money compared to $72. You're risking $180, and you're risking theta decay. So this is time here, right? So this is time. So if that thing ain't jumping every day, if it ain't moving every day, you're risking losing money. And so basically, especially with Apple and popular stocks, you learn how to read option Greeks. But if you buy just a single option, you better be sure you're right on the direction and that it's moving, like it's going to pop. And that's usually speculative on something popping. So, but obviously you have a higher return rate, right? You make more money here, but much higher risk. So uh, you have a higher chance of making more money, but you have even more higher chance of losing all your money. And that's kind of where greed comes in at, because hey, you could spend a little less and have a little bit more guarantees and have enough money to come back to the table and play some more later, right? So let's do a credit spread real quick. So a credit spread basically is it's a low risk trade, but it's a high penalty. I think that's the best way to explain it if you're wrong. So now we're going to do the opposite on a credit spread. On a credit spread, let's say on Apple, we're going to do, so the credit spread, you're basically saying the credit put spread, excuse me, they say that properly. I don't really do call spreads, so that's why it's not even in my, I'm not even thinking about it. You do a call credit spread or put credit spread. I always do put credit spreads because I feel if I'm wrong, I'll still have time for the stock to recover. Like we're naturally in a bull market, so I feel it's better to try to wait out the market correcting and going back up than if you do a call credit spread. If the stock goes up on you, you have to hope it goes back down, right? So anyway, and that can be a little confusing, but so if we do a credit spread, first thing we're going to do is sell an option. So in a debit spread, we bought one. So we're going to sell an option. So we sell a bid. So it's 244, and then we're going to go. Let's go $2 out. So we're going for 120, and we're going to buy the 118, and so that's going to give us a credit of $66. We're not paying anything. It's going to give us money, right? But the catch is you have to have margin. So what it's going to do is it's going to subtract out of your margin the risk. And so the risk is if this stock drops, if this gets in the money, you're in trouble. So if Apple drops down to 118, you're going to owe the difference between 100 shares of 118 and 100 shares of 120, which is $2 times 100. That's $200, right? So minus minus in the credit. So you're risking $200 um, in order to make $66. Or if you get caught here, and let's say it goes down to 119, and so your protection, which is this 118 here, but if it goes to 119 and it closes at 119 on expiration day, you're gonna owe your broker $120 worth of shares. 100 so $12,000 basically um, of shares on Apple because it didn't hit your insurance policy here, right? So sometimes it's nice to keep them tighter, but you lose. It's not. It's you don't make as much money, and also if you because you can roll your options too. So if it starts, let's say it moves against you, starts getting down at 120, you can roll your option to 119. But that's a whole nother strategy. So anyway, looking at options, credit, and debit spreads, they're nice strategies. Especially, I use credit spreads if I just know it's going up, or if I see a trend line, right? So let's say if I go like Apple, I would my first thing is using the Bollinger Bands. I say, okay, depending on how far out you're going, though. But let's say you're doing a 1 week option or something like that. I'll say, okay, Apple probably shouldn't go past 118. Or you can go, you want to be more safer, you use this line of support. All right, probably want to go to 114 is highly unlikely. But those highly unlikely things are already priced in. They know. And the market knows, so they're going to get a little opportunity to make money there. So let's go down. See at 114. So if you bought a credit spread here and you did it by $2, you're making $20, right? Which isn't bad. But you always increase your share size. So you can do 10. You're making $219, right? But some brokers calculate the risk differently. So I mean, you're still risking $200. They might charge you more. The more the spread, like, so let's say you didn't go here, you went way out. Let's say you took it way out to 108 for your protection. That's a lot more risk. So the more risk, the more they're going to require you to have in your margin account. So that's something to look into. Depends on your broker. Some broker will charge just the $200 risk that you're taking. Some will charge more. Or some will charge the whole amount of your option shares. So it changes. I mean, I'm saying this now, and if somebody's looking at this video from a year from now, that might change too. So just look into it. Give you something to think about. Credit spreads are awesome because as long as it doesn't, I highly doubt Apple goes down to 114. You can make a little change, but you're like risking $1,000 or whatever, a couple $100 depends on your broker, and your option account level. But they'll charge you for that. I mean, not a charge. I'm sorry. It's a credit, so it's a deposit. So that's a better. It's a deposit. So because you'll get it back once the option expires, they'll give you your margin money back, and you'll make all the 100% of the credit if you decide to let it go to expiration. So anyway, this is my strategy. I like to trade it, so that I use that strategy. You look at them other videos. I use the RSI and MacD indicators. I take my time searching for stocks that are MACD and RSI friendly, that's on the verge of breakout. And so I use that with a combination of debit and credit spreads to trade the market. So that's my playbook. That's my Bill Belichick Patriots playbook. I'd love to hear about yours. Feel free to leave a comment in the description. In the comment section. Also, don't forget to like and subscribe so I can continue to show YouTube's algorithm that, hey, this is useful information. Also share my stock picks after the lengthy search I do on these. These are some of them here as of today. Anyway, that's debit and credit spreads. Kind of Cliff Notes version of it. Feel free to do more research. Feel free to ask questions. This is Reggie, and I'll talk to you in the next video.